The real beginning of this story was not on Wall Street, not in a government archive, not even in a trading room. It began in 1964 in a small, unremarkable town in New Jersey, a place called Pennsauken. On a quiet summer afternoon, the bell of a small gold and silver shop rang. A 14-year-old boy walked in. While other kids his age were obsessed with baseball cards, model airplanes, and science fiction novels, this boy stood motionless in front of a display case, ancient coins, gold, silver. He wasn't interested in movies. He didn't care about pop culture. He asked only two questions. Where did this coin come from? And when does its price rise? And when does it collapse? His name was Martin Armstrong. A year later, still underage, Martin used every dollar he had earned working weekends in that shop to buy 1,000 rolls of Canadian silver coins. Almost immediately, the market went into a frenzy. Silver prices surged, collectors rushed in. Demand exploded. Each roll, once worth just a few dozen dollars, climbed to nearly $1,000. Martin held 1,000 rolls. Do the math. 1,000 times 1,000. $1 million at 16 years old. To put that into perspective, at the time, the average American earned less than $6,000 a year. $1 million was the combined annual income of roughly 200 families. If the story ended here, it would be a familiar myth, the genius teenage prodigy. But this story doesn't follow a script. The first collapse Martin didn't sell, he waited for higher prices. And then, the market reversed fast, violently, prices collapsed. The $1 million vanished as if it had never existed. He went back to the same shop, wiping counters, counting coins, working weekends. Strangely, he wasn't devastated, because something else had happened. For the first time, he felt the market breathe. At his father's suggestion, Martin reinvested what little remained into mutual funds, professional stock management. History repeated itself. In 1966, America's 16-year bull market ended. The Dow Jones peaked near 995, then collapsed to 735 within months, a 26% decline. Once again, Martin was nearly wiped out, but in his mind, this still wasn't failure. He believed something fundamental. Markets were linear. Ups and downs were noise. Time would smooth everything out. Listen carefully. This idea would later become the foundation of value investing, championed by Buffett and Munger. Martin was 16. Then came a single moment that shattered his worldview. A high school classroom. A black and white film from 1937. The film dramatized the 1869 financial panic, known as Black Friday. Gold prices in the movie were portrayed as absurdly high. Martin laughed. He knew gold history. That's impossible, he thought. Pure Hollywood fiction. But one number stuck in his mind. $162 per ounce. Days later, he went to the library. He opened an original 1869 New York Times. There it was. Gold had actually reached $162. 17-year-old Martin stood frozen. If prices weren't linear, if markets didn't always return to normal, then what were they following? Martin enrolled in college, studied computer science, dropped out within months. He audited economics classes instead, and walked away disappointed. To him, economics explained the past. It never predicted the future. So he left academia entirely. He moved to New York and made a living trading antiques. Paintings, furniture, sculptures. Everything was a vehicle for price movement. Everything except coins. He never sold those. When you touch these coins, he later said, they speak. He immersed himself in history. Not decades, centuries. Currencies, wars, empires, collapses. Then, near age 30, a number appeared. 8.6, not intuition, not revelation, pure statistical exhaustion. From political conspiracies in 1683 to the 1907 banking panic, he catalogued 26 systemic crises across 224 years. 224 divided by 26 is approximately 8.6. More unsettling. The spacing between crises kept landing on the same interval, again and again. Armstrong made a claim that sounded insane. Economic crises are not random. They occur like clockwork. No one believed him. Until Japan called, then the Japanese government did. Quietly, the Japanese Ministry of Finance hired him as a consultant. Soon after, Armstrong founded his own firm, managing hundreds of millions of dollars. Yet he insisted, "I'm not investing, I'm forecasting." He stacked history on top of history, wars, revolutions, market crashes, all falling on rhythm. He noticed something else. 8.6 times 6 is approximately 51.6 years, a full generational cycle. Empires rise and fall within it. Technologies replace each other. Power shifts. Then came the number that sent a chill down his spine. 8.6 years approximately, pi times 1,000 days, 3,141 days. At that moment, Armstrong realized he wasn't studying economics. He was studying the geometry of time. And the machine he would later build was not predicting markets. It was warning the future. If the first half of Martin's life was spent standing on the shoreline of history, watching the tides of time rise and fall, then 1987 was the year he stepped directly into the center of the storm. That year, America looked perfect. Inflation was falling. Unemployment was falling. Corporate profits were breaking records. The Dow Jones Industrial Average had climbed from 776 in 1982 to 2,722 by August 1987. In just 5 years, the market had more than tripled. On Wall Street, optimism wasn't just confidence, it was faith. This time is different. We've solved the business cycle. Recessions are relics of the past. And it was in this atmosphere that Martin Armstrong organized a small private conference in Princeton. The audience wasn't amateurs, hedge fund managers, bankers, institutional investors. They expected an unconventional talk, something curious, maybe even entertaining. Instead, Martin opened with one sentence: "A stock market crash is coming." The room froze. No spreadsheets, no balance sheets, no earnings forecasts. Just one explanation: the timing is complete. Then he went further. After the crash, he said the market would recover, and by 1989 reach new highs. At the time, this sounded less like analysis and more like delusion. An antiques dealer, a college dropout, challenging the entire financial establishment. Some laughed openly, some shook their heads, others stood up and walked out. Years later, Martin would write, "That was the most stressful day of my life." He understood the risk. He wasn't placing a bet. He was staking his entire credibility on a single moment in time. Monday morning, the New York Stock Exchange opened. In the first minute, the Dow fell 67 points. Then the sell-in accelerated. Orders flooded in. Screens turned red. By midday, the Dow had collapsed 508 points, a 22.6% drop in a single day. The largest one-day decline in market history. Fortunes evaporated overnight. The shockwaves spread globally. Japan, Hong Kong, Singapore, Europe. No market was spared. History would name the day Black Monday. And some of Martin's clients had already exited the market before the crash. Not because they understood economics, but because they trusted time. Overnight, Martin Armstrong became something else entirely, a prophet. His consulting fees surged to $10,000 per hour. Yet he later wrote, "I didn't predict the market, I simply didn't violate the cycle." Japan's fall. What followed carried his reputation far beyond the United States. By the late 1980s, Japan was at the peak of collective euphoria. At one point, analysts calculated that the total land value of Tokyo's 23 wards was worth more than the entire United States. Everyone believed the rise was permanent. Everyone, except Martin. Standing in a ballroom at the Imperial Hotel in Tokyo, he told Japan's financial elite, "The bubble is about to burst." In December 1989, the Nikkei peaked at 38,957. Then came decades of decline. Japan entered what history now calls the Lost Era. Japanese media gave Martin a nickname, Mr. Yen. But Martin wasn't satisfied. If cycles were real, if time itself had structure, then why not feed all of human history into a machine? That was how Socrates was born, not a normal computer. It stood on three pillars. First, data spanning thousands of years, economics, currencies, wars, population shifts, trade, political events, anything measurable. Second, Martin's cycle models, the core of what would later be called the economic confidence model. Third, a theory he never fully revealed. He called it the principle of universal oscillation, from atoms to galaxies, from heartbeats to markets. All systems resonate. Socrates didn't predict prices. It searched for turning points. When historical resonance patterns aligned, the system issued a warning. In the 1990s, the alerts began to land. 1990, Middle East instability and energy risk. Soon after, the Gulf War. 1994, the Mexican peso crisis. 1997, the Asian financial collapse. Martin's wealth expanded rapidly, but the true breaking point arrived in 1998. A private bank approached him. Its ownership structure deliberately opaque. Middle Eastern capital, defense interests, political figures. They wanted one thing, Russian government bond arbitrage. At the time, it was considered risk-free. Martin refused. The reason was simple. Socrates was screaming. Capital was fleeing Russia at abnormal speed. Later that year, Russia defaulted on its debt. Those investors suffered massive losses, and Martin Armstrong entered the awareness of certain powerful people. September 13th, 1999. Monday. Martin arrived at his New Jersey office. Waiting for him was the FBI armed agents, servers seized, documents removed. Then the charges appeared: Ponzi scheme, fraud, money laundering. But the focus quietly shifted. Not money, source code. The government demanded access to Socrates. Martin refused. "You're not after justice," he said. "You're after control of the future." He was jailed for contempt of court. No jury, no criminal conviction. 7 years. The longest such imprisonment in U.S. history. From prison, his forecast continued. The dot-com collapse, the 2008 debt crisis, Japan's 2011 downturn. At some point, people began asking a dangerous question. Is this still coincidence? Martin was released in 2011. He began speaking publicly, launched a website, became an outspoken critic of governments, and his outlook grew darker. He believes the world is now deep into another 8.6-year downward cycle. A major turning point, he argues, arrives around 2030. Further out, he warns of something larger, a global conflict, without a formal declaration of war, around 2032. Not tanks and trenches, but economics, energy, technology, power structures. Some believe him, others dismiss it entirely. But by now, the real question is no longer whether he's right. It's this: do we actually understand time? Is history truly cyclical? Or do we simply impose meaning after the fact? Martin may exaggerate his model, he may ignore failed predictions, but he reminds us of one uncomfortable truth. Humanity's greatest arrogance is believing we live in an exception. If cycles exist, most people experience only one season. But families that endure across generations remember the wind before winter arrives, and that is what makes the story unsettling. Because if no one ever tells you what spring looks like, how would you know when to plant? Welcome to Orphy. The story of time is far from over.